In this video, I'm going to break down credit spreads, one of my favorite income strategies in options trading, which I think is perfect for generating income with defined risk. And stick around to the end because I'm excited to show you how to use Barchart's new charting tool to visually see a credit spread's profit and loss potential and other metrics. Once you master these charts, you'll be able to find trades that work for you faster while increasing your chances of profitability. All right, let's get started. Have you ever wanted to sell credit spreads but weren't sure what the numbers might look like? When we use an option screener, we get all sorts of values that go along with the trade, which are fine. But what if we could see them visually before you place the trade? Well, with Barchart, now we can. First, let's cover what credit spreads are. Credit spreads are strategies that involve two trade legs, a combination of a short and long option. The concept of this strategy is to receive more from the short options than what you pay for the long options, and that results in a net credit. When selling credit spreads, the goal is for all the options to expire worthless. Now, one of the best things that I love about credit spreads are their defined risk structure. When you sell a single call or put option, you're at risk of assignment, meaning you either need to sell or buy the underlying asset at the strike price, depending on the type of the option. And this has significant capital requirements and could most likely lead to losses. However, with a credit spread, your long option serves as a hedge against assignment risk. And should you get assigned, the maximum loss is limited to the difference between the strike prices minus the net credit received at the start of the trade. Now, while credit spreads and debit spreads both use two or more options, the objective of a debit spread is to reduce the net premium of the long option. For example, in a bull call spread, a trader buys a more expensive lower strike call and sells a cheaper higher strike call, reducing the cost compared to buying one long call alone. And compare that with a credit spread, such as a bear call, which collects a premium up front and profits as long as the stock stays below the short call strike price, well, it'll benefit from time decay rather than price movement alone. Now, there are two types of credit spreads, the bull put and a bear call. Let's start with the bull put spread, which involves selling a put option and then buying another put option at a lower strike price. The strategy's objective is for the underlying asset to trade at or higher than the short put strike at expiration. That way, all trade legs expire worthless. And it's mainly used in neutral to slightly bullish markets. Here's a quick example of a bull put spread. Say you sell a $100 strike put for $3 and buy a $95 strike put at $1. That gives you a net credit of $2 per share or $200 per contract up front. Both options will also have the same expiration date. When you sell this spread, it means that you're bullish on the stock, expecting it to stay above the $100 strike. If it does, both options will expire worthless and you get to keep that $200. But what if the stock dropped below $95? Well, in that case, the spread is in the money and you're out $500 on the $5 spread width. But you do keep your $200 credit, so that loss works out to $300. A bear call spread works similarly, but in reverse. The strategy involves selling a call option and buying a call option at a higher strike price, and it's primarily used for neutral to slightly bearish markets. Here's a quick example. You can sell a $100 call for $3 and buy a $105 strike call for $1. Both have the same expiration date. The long call costs $1, and the premium that you collect on the short call could be $3, and that gives you $2 per share or a $200 net credit up front. This strategy suggests you're bearish or neutral on the stock and expect it to stay below $100. If it does, both calls expire worthless and you keep the full $200 profit. But if the stock rises above $105, the spread is now fully in the money. You lose the $500, but again, since you collected $200, your max loss is now only $300. Now, if you're wondering how I came up with these numbers, let me show you the formula so that you can calculate it yourself. For credit spreads, the maximum profit is limited to the net credit received, which is taken by subtracting the premium paid from the premium received for the trade, multiplied by 100 for every credit spread you sold. In the previous example, you buy the long option for $1 and sell the short option for $3, giving you a $2 net credit per share times 100, so that makes it $200. Meanwhile, the maximum loss is the difference between the strike prices, also called the width of the spread, and the credit received. Then you multiply that by 100 for every credit spread that you sold. In both examples, the difference between the strike prices is $5. So then you just subtract the $2, multiply that by 100, and that gives you a $3 maximum loss. Now, it's important to know every aspect of your credit spread trade before trying it out. So let me show you the calculation for break-even prices. On a bull put, the break-even price is taken by subtracting the net credit from the short put strike. In this example, that's $100 minus $2, and that makes it $98. For a bear call, you add the net credit to the short strike to get the break-even price. So that's 100 plus $2, which equals $102. Now, let's talk about the setup and risks. Selling credit spreads with wider strike widths is safer and will lead to higher net credit and higher chances of profitability. However, the potential maximum loss is also higher. On the other hand, if we sell credit spreads with tighter strike widths, the net credit will be lower, as are the chances of the trade being profitable. However, the maximum potential losses will also be lower. Here's a quick example for a bear call spread using Apple. Here's a trade with a 20% chance of profitability compared to one with a 91% chance of profitability. Finding the right balance between risk and reward will depend on your trading preferences, but usually it's better to sell credit spreads with a higher degree of safety. Besides, you can sell a lot of them, which can improve your overall net credit, but again, it can also potentially increase your maximum loss. Now, let's talk about some important factors that could affect your trade. First, it's important to remember that all options lose value as they get closer to expiration, and that's called time decay or theta. With credit spreads like the bull put or the bear call, positive theta works in your favor because you want those options to expire worthless. Beginner traders may get confused about losing value. So when I say the option loses value, I mean that their current premiums are going down as options get closer to expiration. It doesn't affect the credit that you receive. That's entirely yours, regardless of what happens to the trade. Now, with credit spreads, it's also important to know the risks. This is expressed in the probability of profit or the chance of the option expiring worthless. Again, the wider the width, the higher the chance of profit, and vice versa. Okay, so we've covered how bull puts work well in sideways or bullish markets, and how bear calls work in sideways or bearish markets. Now, let's talk about implied volatility. Implied volatility, or IV, is a metric used to predict how much the stock's price will move in either direction within a given period based on current option prices. A higher IV means the market expects more significant moves, which means premiums will be higher, while a lower IV suggests a more stable market, leading to lower premiums. Trading credit spreads with underlying securities with high IV will result in more net credit, sure, but it also puts you at more risk since everyone expects the asset's price to move drastically. You always carry assignment risk with any option strategy that involves short options. If your short option expires in the money, it'll automatically be assigned. Also, the buyer can exercise the option at any time, even if it doesn't make sense. So how do you avoid this? Well, there's a few things that you can do. The first is trading credit spreads with higher probabilities of expiring out of the money. That means wider spreads with higher net credit and potentially higher maximum losses. Though again, that's offset by the lower chance of it expiring in the money. Let's say you have a call credit spread with a short $100 strike and a long $105 strike, and the underlying price is getting way too close to the $100 for your comfort. Well, to avoid assignment, you can buy to close that $100 strike short call and then sell another one at perhaps $103 or $104. Now, if that strike doesn't exist, you can close the entire trade and sell another spread at a higher strike or just move on to other opportunities. Now, let's say your trade is going your way, but you still want to avoid assignment. Well, you can close your trades before expiration or at a specific level. Usually what I do is assign a take profit price. If at any time before expiration, I can close the trade and keep 50 to 75% of my net credit, I'll often close the trade. Still in the green, and I no longer have to worry about assignments, and I can move on to the next trade. I almost never hold credit spreads or any strategies with short options to expiration. Now, when finding credit spreads to sell, it's important to consider your trade details. Like with any market, trading options on higher liquidity assets is often a good idea, so you won't have to wait very long to get a fill. Opt for index funds like SPY or the Triple Q, or bigger companies like the ones in the Magnificent Seven or other mega cap stocks. The next consideration is days to expiration, or DTE. I typically like options with 30 to 45 days to expiration, which gives me a lot of time to make a move. Remember, you don't need to keep your trades open until expiration. You can close them when it makes the best sense for you. Also, when trading credit spreads, it's best to start out of the money. This gives you a better chance of profiting within your chosen DTE. Then, of course, consider the risk-reward ratio. And this is a balancing act. Keep yourself safe from assignment, but get enough credit to cover your trading fees and, of course, make you happy. Now, credit spreads can have high risk-reward ratios, especially for ones with higher chances of profit. In my experience, reasonable risk-reward ratios for credit spreads that have around a 70 to 80% probability of profit is about a 4 or 5 to 1. That means you could lose 4 to 5 times your net credit should the trade go against you. Now, let me show you a real example of a credit spread, and of course, we'll have a look at Barchart's new charting tool, which can help you visualize the results. First, go to barchart.com, then search for your desired underlying asset. For this example, we can take NVIDIA. As you can see on the chart, NVIDIA is moving in a sideways to downward trend, so this could be a perfect setup for a bear call spread. To get the trade details, go to the left-hand menu and click on Vertical Spreads under Option Strategies. Next, choose your short strike price. Remember, NVIDIA's stock price must stay below the short strike at expiration or when you close the trade to profit. And now the stock is trading at $109.67. So let's say you think NVIDIA will not exceed $115 by May 2nd. Well, just type in $115 in the strike field and hit apply. Now here's your choices for the $115 strike bear calls. I can arrange the results based on any of the column headers here, and I'll arrange them from lowest to highest loss probability. And here we have the top trade with a 29.2% chance of loss or a 70.8% probability of profit. The trade involves selling a $115 strike call for $4.20 per share, then buying a $140 strike call for 29 cents. The break-even price is $118.91, and you'll receive $3.91 in net credit for the trade. The risk-reward ratio isn't looking too bad either at around 5 to 1. Meanwhile, the maximum loss is $21.09 per share. Now, if you're an experienced options trader, you can probably already visualize the trade in your head. However, it can be difficult for new and intermediate traders. So, to get a visual representation of the trade, you only need to click on the chart icon beside the expiration date. And here you go, the profit and loss chart with all the relevant trade details. Green for profit zones, red for losses, and the dashed line for the break-even price. It's that easy. Now, if you want to dive in further, you can click on the tabs at the top, like the options Greeks. Then move on to expected move, which I absolutely love. This charts the expected price movement of NVIDIA. So in this case, it looks like the market expects NVIDIA to trade somewhere between $120 and $99 by May 2nd. And that's well below the $140 long strike. Next, the volatility tab also shows where IV may be headed. As you can see, it says volatility is falling, which is good because that means lower chances of bigger price swings. Then, you can also look at the trend tab, where it shows the historical price movement of the stock based on Barchart's opinion and trend seeker features. According to this, it looks like NVIDIA is in for a rough ride, at least in the next few months. So yeah, everything you need to know about your trade is right here. Credit spreads are defined risk strategies that work best in low to moderate volatility environments. Always manage your risk carefully because position sizing can make or break your trade. If you're new to selling credit spreads, I recommend a paper trading account to build confidence before trading with real money. And don't forget to check out the Options Learning Center for more information about all of the other options trading strategies that exist. The more you understand pricing and volatility, the better your edge. Stay patient, stay consistent, and let the probabilities work in your favor. If you have any questions, feel free to leave them in the comments below. Thank you so much for watching, and I'll see you in the next video.